But we're gonna do these, the textbook problems. There's two of them, and, yeah, so we'll go ahead and get started on that. Sorry. Okay. So this is problem 16, and again, it's it's similar to what you're gonna have in the book. I had to do a little bit of shuffling around just to get it to fit, but so here's the exchange rates. This is the important stuff. Over here is some of what actually they did. And so this was a wholly owned subsidiary on January 1st, year one. Talk about the investment here and what the date, what it was on the date of the investment. So that's this one right here. This is the historical for the day it was founded. Okay, so this one is going into the second year. Now, there really isn't too much difference in doing the second year other than the first year. The only thing you have to be careful about is the retained earnings, bringing those over from the previous year. So that's what this is. So bring this over from the previous year, the 80. This will be from the previous year. I just say year one. The rest of it's pretty much the same, though. You don't need any of this other stuff from here. The first year. Okay. Okay, so translate the following financial statements using the current rate method. And let's see, they should give that here. Okay, so the Cruzeiro is what it's dominated in. So they're not changing the money into US dollars. So this will be the current rate method. Okay. Let's see. I'm going to freeze the panes so I can go down. So if you want to do this, you go up to the top and go to view. And if you freeze the panes, you can always unfreeze them too. You can have it so it stays on top. And if you ever want to get rid of it, you just go to freeze panes and say unfreeze panes. Okay. So we are going to be using the current rate method. And pretty much everything goes in at the average cost. I don't think there's anything special on this one. So we're just going to use the average cost for this one. So that'll be 72. Goes for everything. If there was like a sale of asset or something like that, we would use a historical, but there isn't anything like that there. So, all right. So this will be our gross profit. It'll be our income before taxes. And I don't know why I'm doing that yet. You can just sum it. So this will be our net income. Okay, so this is. And again, the reason why we use the average for the year is that you have sales throughout the year. You know, you have sales in January, February, March, April, blah, blah, blah. And same thing with all these other costs, they happen throughout the year. So that's why we take an average. It is possible that an average wouldn't be the proper way to do it. For instance, if they were a company that maybe made all their sales, like there's some companies that make, 80% of their sales are made in December. So if it really is skewed, then the average rate wouldn't be a good one, but for the most part, it's a good one. Okay. So. And you might say, well, what do you do if it is, maybe if you made most of your sales are made in, in your year end, you'd take a weighted average of it. Okay, retained earnings. And this is the one where we said they just come in at, in this case, 880 cents. Now, again, quite honestly, this would probably just come in as a one line item just from the previous year, whatever they had on the previous year. So yeah, usually this one is a given, but that's fine. Okay, and we get our net income is the same as up here. Same. Dividends were paid on. Let's see, this is dividends. Okay, so this will be the ending retained earnings for. It's a little brighter. Yeah, let's make them all the same. How about that? All right. So this would be our retained earnings. And by the way, when you look over here and you see, a composite, well, that's because it has more than one rate in it. So composite actually isn't a rate up by itself, but it's, the outcome of a number of different rates. So that's when you see composite, you start looking around for a composite rate. It's not there. Okay. Balance sheet. Oops. For the current rate method, which is what we're doing, most everything goes on at the current rate. The only thing is the capital retained earnings don't, but everything else goes out at the current rate, so. At year end, the current rate. Is 0.70. Write that down. Hey, I can, okay. Okay, so everything goes down at the current rate, and if you're wondering why that is, why don't we go back and see what we paid for it and all that? It's because we're not changing this out of the local currency. It's staying in the same local currency as it was before. So whatever the current rate is for those, that's what we're gonna translate the entire thing at, because it's not being changed into US dollars. Liabilities go in at the current rate always, because that's what you owe. And Marky just did a dumb. Let's try that again. Multiply. I think I hit plus. There we go. That looks more like it. Capital stock. Here's a question for you. What rate does that go in at?
Would that be 0.84 historical?
Perfect. Yep. Yeah, so this 84, that's what it was when they actually bought the stock. So this is actually going to go in at the historical rate. And then our retained earnings are at okay. I'm gonna do something. Man, we don't need the rates anymore. Okay, so what am I? So coming down here, so we have so this is our total assets. Change it so it doesn't get confusing. Okay, so our total assets are 316,400. Our total current total liabilities and owner's equity is 340,240. So is this going to be a gain or a loss?
A loss?
Yeah. So this cumulative adjustment here, let's make that. So this cumulative translation adjustment, by the way, this is, I think I showed you this before. You'll also often just see this called the CTA. And so we're gonna have a loss of 23,840. And so when we translate this into our financial statements, we'll take all these accounts, and translate them over. This is it in dollars, so we'll translate sales of 388 $1,800, and we'll translate the cost of goods sold and blah, blah, blah. So all these will come over onto our books in a journal entry. One of those journal entries is going to be this cumulative translation adjustment, or CTA, that will come over at the same time. So when we take our two, when we combine our corporations, to have consolidated financial statements, take them and smash them together, we're going to have that all come over as a journal entry. That's a consolidating journal entry. And the consolidating journal entry is there for a moment. You make a consolidating journal entry, you run your financial statements as consolidated financial statements, and then you reverse the consolidating entry out, and you just go back to being your normal business, and they run their business the way they're running their business, and so on. So that consolidating journal entry, first you translate it. Well, actually, first you turn it into US standards, then you translate it, comes in, you do the journal entry, the consolidating entry, run your financial statements. After your financial statements are run, you reverse out the consolidating entry, and then you start back up as if nothing happened. So that's problem 16. All right, the second problem, and this one's gonna be more like the one on the exam. The second problem is, it's a little bit more involved because we're going to do it both ways. We're going to do it as using the current rate method, and then also the temporal method. So we're going to do both ways on this. All right, and I'm going to go through and kind of label these as we go. So this is just for 1 year, so that's good. So exchange rate was, okay, so this will be the historical amount. So they had 300. Okay. All right, so down here, so these numbers are all in the South African rand. I'm not sure how they came up with ZARs, but I'm sure there's some way they came up with that. But so the South African rand will be the currency that these are in down here. So for instance, this long-term debt and capital stock should be down here. Yeah, so that's what those two are. Plant and equipment, 5,000. Yeah, and so the plant and equipment, same thing. Cash is going to go up or down, and you use that in your business, so that could be all over the place after 1 year. Started out at 300, but it's I'll also notice here there are no retained earnings because it's the first year. Get rid of those. It's the first year, so we're not going to have any retained earnings. There's nothing to retain. By the end of the year, we'll have some, but at the beginning of the year, we don't have any. Dividends in the amount of our 20,000 were paid on June 1st and December. Okay, so I'm going to come over here. So June 1st, this will be a dividend payment. Close. So June 1st is a dividend, and then also December 1st is also a dividend, so December 1st. Ending inventory was acquired on November 15th. So November 15th, this will be the ending inventory. The cost of goods sold, obviously. All right, I think that's all we need, right? Average. This will be the current. Okay. So we go to. So we'll start with this one, the foreign currency one. A little bit easier. Okay, so we're gonna be using this method, the one we just did. Okay, so pretty much everything is gonna go in at the average cost. I don't think there's anything on here that's too kooky. Nope. And I'm gonna freeze my panes. Okay, so what rate would be for the sales?
0.096.
Yes. And that's pretty good. It's gonna be pretty much everything, right? Yeah. I don't think we have any specific gains or losses here. I didn't hear about it. Okay. Yeah, so we'll use this 0.96 rate for pretty much everything on the and the idea is that throughout the year you're buying stuff at about the same rate. Okay, so this will be the gross profit. Okay, I think you should have got that. Any question on that? But if did you guys get anything different than that? All right, so that's the average throughout the year, and again, a lot of stuff in the income statement is done throughout the year. Okay, retained earnings. Now this translates at here to the 0. We just started. The income comes in at the same amount. Okay, dividends, these were paid on specific dates, so. And realize that this is a check being sent out to the parent company. So that will be taken out of their books at the historical rate. So to see June 1st, I'm gonna highlight this. Okay, so June 1st was 0.95. I'm sorry, 0.095. And the second one on December 1st was 0.105. Okay. Gotta find a better color for this. How about this? There, it's almost invisible. How about that? Hardest part about taking the CPA exam is knowing what color to make things. All right, too bad. Yeah, we'll leave it. Okay, so this would be our retained earnings. Okay, now cash. And you'll see that most everything comes on at the current rate. The only thing that doesn't are the capital stock stuff down here and the retained earnings. So the current rate is how much?
.110.
Yep. Yep, there's the current rate 110. So that'll be for pretty much everything. Oopsie daisy, let's try that again. Okay. Do that. Okay. So that would be our assets. And that would also go for our any liabilities we have. At the end of the year, what do you owe? If you owe okay, which one's a historical? Oh, I got it marked. Thing, I guess. Make that leap that you guys know how to read. So, all right. So this will be any retained earnings is this. Again, that's just bringing it down from up here. And so we're going to do it without this cumulative translation adjustment because It's easier just to go ahead and do the whole thing. And then figure out what the. All the only way that they make it, they basically go through all the changes that happen here, but it's just as easy just to do it as normal, then it's come up with a difference. Okay, so. We had assets of 104 and we have. Liabilities and ownership of 97. So this difference is gonna be a gain or a loss.
Again.
Yep, good. It's good. It can be gain. We have more assets than we have, basically ownership rights. Claims on it. So this will be a gain of 71. Yep, that comes out to 0. So yeah, so this would actually be a gain. Of 7140. And again, we translate everything over. This will come over just as part of the equity section. I don't have them broken out here, but it's part of the equity section that'll come over and it'll just be part of that consolidating entry. So first thing they would do is translate the books from international standards to US standards if there is anything to translate. And then they would do the I shouldn't say translate, that's a bad way. Convert from international standards to US standards and then do the translation to the financial statements into US dollars, and then this would be picked up on the consolidating entry. Okay, so that's the current method. Now for the more confusing one, we'll go to the temporal method. And the temporal method is a little bit more confusing because everything gets changed into US dollars immediately. So it becomes a little bit different because because these are changed over to US dollars immediately, they you generally end up using a lot more rates, basically. Okay. So sales. I apologize, but I'm gonna move it down just so I have it on my screen. Oh. Well, okay, so sales, we have our average cost for our sales made throughout the year, so we use the average cost. Should be the same as last time, which is this 0.96. Do the wrong thing, 0.096. So that's exactly the same as the other one. Okay. Cost of goods sold is here. So the cost of goods sold, the historical rate is 90.094. Oops. Well, that's odd. Sorry about that, it's some weird formatting thing I did. Okay. Depreciation expense. Now, this is where it gets a little bit tricky. In that we have to go back to the historical cost of what we're depreciating, which is down here. So this plant and equipment, you recall from up here. This plant and equipment, that was put on when we first bought the place at the beginning of the year, so we're gonna use that as the historical cost, so. What will be the rate for the depreciation expense?
Would it be 0.090?
Yep. Yeah, so you gotta go all the way back to the very beginning to get that one. You know, the first day we had that we put that equipment on the books. Other expenses, where are those gonna go in at?
Would it be the same as the depreciation expense?
Actually, it's going to be here. So among your other expenses, for instance, like let's say rent expense. And you pay rent throughout the year, it's gonna be an average. So we're gonna use the same as we use for the sales, 0.9, scratch that, 0.096. So some expenses go in at cost, those that are linked to historical costs, for instance, cost of goods sold, depreciation, those are all based on historical amounts. They're not something that happens throughout the year, evenly. Okay, it is, well, actually, it is possible that if the inventory, if it's bought throughout the year evenly, and that it's not strikingly different, that they can actually use the average for the historical, but anyway. Okay, this remeasurement gain, we're gonna wait till the very end to figure that one out. There are ways to figure it out now, but it's a bunch of extra hoops, really. You can just do it right to the end and then go back up and plug it in. Okay. Income before, oh, I gotta do this, sorry. Income before taxes, we add that up. Income taxes. We'll use the average for that. Okay. So there's our income. Now, we really should just call that our tentative income, because we're going to have some kind of remeasurement plus or minus come through here. So this is going to be kind of the tentative income. Okay, coming down here, retained earnings, 0, net income. And you can see on this one, it really is a composite rate. You got 1, 2, 3 different rates going in there. Dividends. This will be the same as before. So 0.95. said that wrong again, 0.095. And 0.105. See, I'm consistent with my mistakes. That's the great thing. Okay, so this would be, multiply those out. There. Okay, so retained earnings is that. I'm going to put that right in here. Okay. So balance sheet stuff. Cash, marketable securities, inventory at market, which we're not going to do for this one, but it is possible. I'll talk about it in a second. But cash, accounts receivable, marketable securities, these are what they call monetary assets. In other words, those are directly relatable into US dollars, so that's why they still do those at the current rate, which is what, 110. So these two, you know, they're cash, which is the local currency, like it's false. B. Okay. So these two will both go in at the current rate, which is really the end of the period. I don't know why they call it the current rate, because it really is like the year-end rate, but anyway. Okay, inventory. Okay, so what do we put the inventory in at?
Would it be 0.100?
Yep. Yeah, so what they're saying is that all the ending inventory came from a purchase on November 15th when it was this. Inventory can be a real headache just because it could be, you know, you could have dozens of rates. You know, you buy inventory every day sometimes. So, okay, plant and equipment, those go in at historical. So what are those gonna go in at?
0.090.
Yeah. Yeah, it'll be the same as up here for the depreciation expense. It'll go in at the 90. Or 09, I'm sorry, 090. I mean, this stuff isn't terribly hard. It's tedious, you know, it's not. Okay, so this would be the total assets. Okay, coming down here, look over here, firstly, all the liabilities go in at the long-term rate. The only unusual one here is the deferred income at historical rates, and I'll talk about that. This is when someone hands you money ahead of time. So whenever they hand you money, if you're converting that into US dollars, whenever they hand you the money, you convert it into US dollars. So that's why that deferred, that liability would be at a particular point in time. Which is, yeah, so current rate is 1.110. And the same thing for the liability. Common stock goes in at the historical rate. 0.090. What the heck did I do? Why is this off by so much?
Receivable rates was
Oh.
1 point. Yeah.
Thank you. Okay, that looks a little bit more. I apologize. Okay, so. So let's take a look at, so this would be a difference of. We have assets of 92,800. People can claim ownership basically of 98,960. So this is going to be a gain or loss.
A loss.
Yeah, it's gonna be a loss. So now we go back up to our income statement. So I remember this number, -6060. Should be easy enough to remember, I guess. So this is our real. Income, and again, we could have jumped through a bunch of hoops to get that number, but it's just easier just to plug them all in. You're gonna, you have to do it anyways, so. There's no reason to do this separately. And then you have the problem, if you do it separately, you goof it up, then it doesn't balance, and you gotta go back and, or it's just easier just to do the whole thing and then figure it out. And those two equal now, oh, good. So our retained earnings will change too, because again, the income dropped from whatever it was, 12,000 something, 12,060 to 6,000. I'll show you something funny about this. And that is, if you just focus on the net income, you just focus on this net income, 6,000. Okay. You go, okay, why do I put a number in wrong here? When instead of 0.094, I put this in. Let's take this out. Let's say I put this in 0.084. Right. So I made a mistake. I put this in. We would come up with a correction of 12,060. Income would be exactly the same. Here's the question, why? I put the wrong number in here, and yet we got the correct income. take that out for a second. Notice that this net income raises retained earnings, right? Coming down here, this retained earnings is even higher than before. So the difference is gonna be even more. So even if I were to put in the wrong rate, I would still get the correct income. Now, my cost of goods sold would be off and the remeasurement gain or loss would be off. But the income would be the same. It's kind of an unusual thing because again, it goes through the translations, and if you have a gain in the translations, it's gonna put that in your retained earnings, which is going to make your difference even bigger. So it's kind of a strange thing when it comes to translating them, because translations turn into income, and the more income you have, the more difference you have. Now, it's only for this temporal method. Because notice, if you did that same, if I made that same error down here, it would show up in this cumulative translation adjustment down here. The income would be misstated if I did it up here, because there is no, we don't have this remeasurement gain. So if you made the mistake on this one, if I did, it would be a no-no. You'd be overstating your income. But if you do it down here, while it does mess up the accounts a little bit, the actual income will be correct. Question on that? Hey, I think that's it. So on I'm gonna send out the exam, and on the exam, there'll be one similar to the problem we did in the book, and there'll be one similar to this one. In fact, I'd make a few changes on this one, but it's basically the same thing. And so you're gonna have two problems. Well, no, it won't be like this. It'll be like this one. It'll be like problem 17. This will be similar to the exam. On the exam, I do only one underhanded thing that I can remember. And that is I put the the cumulative adjustment and the remeasurement gain, I put those on both of them. So you have to know which one to do. If it's a current one, you do the cumulative. If it is a temporal one, you're going to do the remeasurement. But other than that, it's pretty much the same. Any questions? Not bad, huh? Okay, I'm gonna write down your name, put extra credit points on your tests. I could download these two. If I ever forget that, it's always there, but it's just easier just to write them down. And any questions on anything? So and I can tell you that the chapter 6 one is going to be on one of those transaction ones where you sell something or buy something from somebody in a different country, and that transaction has a risk that the exchange rates can go up or down. And then one like this big one here, the chapter 6 one is worth 30%, and the bigger one like we just did is 70% of the test. Questions? Okay, well, I'll send, yeah.
Is it just gonna be like problem questions or also multiple choice type?
No multiple choice, and the reason I took I didn't do the multiple choice is the definition ones were not that important, and then they also had the multiple choice ones were absolutely huge, and I didn't feel like trying to whittle them down. You can try to whittle them down a little bit, but for stuff like this is really big. I think sometimes it's just better just to here's what you're going to do, and not to put too fine of a point on it. Now, the CPA exam obviously they use multiple choice questions in that, so it's not a bad thing to get used to. But once you start working, nothing you do has multiple choice questions. So, as far as a practical thing, what we're gonna do is, I think, more practical. Not that anything wrong with multiple choice questions, but to answer your question, then, there will not be anything other, there'll be two problems on there. One on chapter 6 and then one on chapter 7, and the chapter 7 one will be, kind of big, like what we just did. It'll be like this. Okay. Yeah, so no multiple choice. But I'm gonna go ahead and give you guys the multiple choices as if we would have done the multiple choice questions. Yeah, I just don't think they're as important as the problems. Okay, any other questions? All right, I will send those out fairly quickly, probably in the next 10-15 minutes. Oh, let me go back to the nope, not that. It'll be due a week from Friday. Okay. All right, well, have a good evening, and hey, we hour early, yay. So I'll send that out, and I'll see you guys in a week. Okay, good night.